All right, this is the PowerPoints that I have shared in your Google Classroom. All right, we'll go through the PowerPoint today, and inshallah next class we'll do some tutorial question on this topic. Yeah. All right, financial accounting and reporting. This is topic number chapter 4, but actually it's a topic number 5. Yeah. All right. Can you see the slide clearly?
Yes.
All right, so these assets is under chapter 4 is looking at the property, plant and equipment, or sometimes we call it as a tangible assets. All right, so PPE or property, plant and equipment. So at the end of this chapter, we should be able to explain how economic events results in assets. So because later we'll see that this PPE is part of your assets and it appears in your statement of your financial position. And then you have to describe the objective of having different types of asset to users of accounting information, identify and classify different types of assets, recognize different types of assets, measure initially different types of asset, and present different types of assets in the financial statements. Yeah. All right, so it's a bit small, but I hope that you can see this clearly. So the asset can be classified into current asset and non-current asset, right? So current asset is the asset that is highly liquid. It means that you can convert those assets into cash immediately, all right? Or it takes shorter time for you to invest. For you to convert the asset into cash. For example, cash is cash itself. All right. When later we see that cash, you also have the cash equivalents. Inventory are your stock. So in order for you to convert your inventory to cash, then you have to sell the inventory. So if you sell your inventory on cash, then you get cash immediately. Yeah. And then you also have asset under the form of receivable. So how you convert receivables, so make sure that your debtors or your receivable pays your debt, then you get the cash. All right. And then you also have your investment. So investment here, there are two types of investment, the short-term investment and the long-term investment. So in the short-term investment, whereby you invest in shares, for example, and then it's easier for you to convert into cash, for especially if you purchase shares in the open market. All right, so now you can convert, you can sell your shares anytime, all right, online. But if your investment is in the form of land or building, for example, then it will take longer period for you to convert that into cash, because it's not easy, all right, for you to sell your land, your building, or even your machine. All right, it's not that immediate, right, as compared to your inventory and receivable. That's why it's called non-current asset. All right. So here the non-current asset are categorized into two. One is what we call property, plant, and equipment. All right. And the other one is what we call intangible assets. So PPE sometimes is also called tangible asset, but now the term used in the financial statement is the property, plant, and equipment. So when you have this non-current asset, whatever asset that you have here, whether it's current or non-current, all right, of course, you have to look at the objective of having that asset. And then you should know what is the definition, right, in order for you to identify that as an asset in your accounts, and how to recognize, how to do measurement, all these things, and how it is actually presented in the financial statement. Yeah. So property, plant, and equipment, we have one type, and the other type is intangible asset. So next round, inshallah, in next class, for example, maybe we can touch on intangible asset a bit, all right, because this will also be covered in your midterm, which is next week, Friday. Are you aware of that? I think that I've given you the note, right? Your midterm is next Friday. All right. So when this topic is actually looking at the PPE. So an item is an asset when the entity has control over the asset. So when you want to decide whether is an item is an asset to the company, so you must make sure that, okay, do the entity or the company has control over the asset. Normally, if you have control over the asset, then it can be your asset, all right? Asset arises from the past transaction or past events. So normally there is a purchase of the asset. You know what I mean? Students who have to request to admit to the class through the through the Gmeet, all right, please list down your email in the in the WhatsApp, so that I can include your email in the invitation, so that you don't have to request for admission every time. Yeah, you come to class. Okay, arises from the past transaction. Normally, you purchase the asset in the past, so you are the owner of the asset, and then an asset always generate future economic benefits, right? Is expected to flow from the entity, can be derived from the use of the asset in the production of goods or services to be provided by the entity. So it's always expected that an asset will provide future economic benefits to the entity, right? All right, a new machine was purchased by an entity to increase the number of production, right? So how you look into whether is it an asset to the company? Yeah, is the entity has control over the machine, because the machine was purchased by the entity. So once you have when you purchase the machine, it means that you have control over the machine. Yeah. And then, all right, past events is by purchase of the entity, purchased by the entity of the machine. And of course, for future economic benefit, because the machine will help the company to increase the number of production. So for all these three items, you know that, okay, these can be categorized as an asset. Yeah, the new machine is an asset to the company. All right, property, plant, and equipment, the objective of providing information on PPE. So remember that PPE you have in your financial statement, you do have PPE in your asset. So why is that important that you need the information about PPE? All right, it's useful for primary users when they want to make decision whether to buy or sell the shares. Shares here refers to the shares of a company. Users here, we are referring to the investor, right? If a company or investor wants to invest in a company, they want to know about the PPE of the company. All right, for example, Mr. A is a potential investor and considering to buy shares in Axis Berhad. He will assess the amount, timing, and uncertainty of the future net cash inflows in terms of revenue generated from the use of the PPE. He is also interested to know the current value of the PPE, and he will buy the shares in Axis if the estimated amount, timing, and the uncertainty of the future net cash inflows meet his own expectation. So this is how you want to make use of the information from the financial statement, looking at the PPE, and then whether you want to decide to buy or not to buy the shares of the company, right? So this is an example how this information helps an investor, right, to make a decision. Okay. An item of PPE is classified as PPE if it is identified as an asset. So just now we know whether is it an asset or not. It has to be a control, past event, and generate future benefit. And also it has to meet the definition of PPE. So what is the definition of PPE under MFRS 116? What is MFRS? Anyone? MFRS?
Malaysia Financial Reporting Standard.
Yeah, very good. Malaysian Financial Reporting Standard 116 give the definition of PPE that are held for use in the production of supply or in the production or supply of goods or services, for rental to others, or for administration purpose, and are expected to be used for more than one period. So normally the asset will always be used for more than one period. If you can only use it for one accounting period, then normally it's not an asset. We could we put that as an expense, right? It's a supplies, for example, right? Focus Eye Berhad acquired an advanced optical lens making machine to produce lenses. The machine is expected to be used for 5 years before being scrapped. So here, all right, looking at the accounting here, now we have to, there's so many things, all right, now, as compared to years before, all right, or even 10 years before. So there are so many things that a company acquires, then the company has to decide whether what is acquired by the company is an asset to the company. So whether you want to see whether is it an asset or not, then you have to go back to the principle just now, whether you have control over that, what are the past events, and whether that item generate future benefit. So you look at, for example, in this case, you have a advanced optical lens making machine. So this machine, you have to decide whether the machine is an asset to Focus Eye Berhad. So how you decide whether it's an asset? Yes, it's a physical resources, all right, and used at the entity's discretion, because you purchase that, you decide how to make use of the machine. So you have control over the machine, and it was purchased by Focus Eye, so that is a past event, and then the sale is expected to result in the flow of cash, because why? The advanced machine can help the company to maybe produce more lenses, yeah. So these are the future economic benefits of the asset. So in this case, of the machine. So you say that, okay, the machine is an asset, yeah. But the other one is that, does that machine fulfill the definition of an asset? All right, it has a physical form, right? And that it is used to convert glasses into lenses. So it helps for use in production, and is expected to be used for more than 1 year. All right, for more than one period. So in this case, you are expected to use for 5 years. So because of that, then it fulfills the definition of a PPE, right? So the first one, whether is it an asset? If it's an asset, is it an PPE, right? Because remember that under asset, we have two types of asset. Just now we have the non-current asset and the current asset. So this is non-current asset. And non-current asset, we have two types. We have the PPE and we have the intangible asset, right? If you remember the first, around the first slides before, yeah? All right, so now you know that how to decide whether is it an asset, and if it's an asset, is it a PPE to the company, yeah? So that's how you look into that item. So you have to decide, because remember that we are decision makers. Okay, the life cycle of a plant. So once you have a plant asset, all right, in this case, you're talking about PPE, for example, all right. So the life cycle is that, of course, in order for you to have that item as your asset, you have to acquire the asset, right? If you do not acquire the asset, it does not belong to you. You don't have control over the asset. That is not an asset to the company. So first you acquire the asset. All right. So when you acquire the asset, of course, there are costs involved. So you have to know, upon acquisition of an asset, what are the accounting recording that you have to do. Yeah. Whenever there's a transaction, acquisition of an asset, how do you record that in your accounts? Yeah, recording. And then once you have acquired the asset, you will use the asset for a several number of years. Yeah, remember that asset should be used for more than one period. So normally, all right, 2 years, 3, 4, 5 years, depends on the type of asset. And then, all right, after some years, all right, most of the time, you will dispose of the asset, right? You may want to dispose the asset and change and acquire another asset. So the disposal of asset will also take place as part of the cycle, all right, in the company. So whenever you have disposal of the asset, again, you have to record the transaction on the disposal of the asset. Similarly, while you use the asset, remember that there's an expenses that incur, all right, throughout the usage of the asset. So you have to record that as well. Yeah. So these are the life cycle of an asset. Right. PPE are recognized as asset when it's probable that future economic benefit with the item will flow to entity and the cost of the item can be measured reliably. So you want to look at the cost of the item, because in order for you to recognize that as an asset on top of the first two items, right? How do you measure? How are you going to measure that? All right. For example, here, Focus I acquired an optical equipment to monitor and determine the quality of visions of its customers. The equipment was paid in cash for 52,000 on delivery, right? So is it probable that future economic benefit will flow to the entity from the purchase from the optical equipment? Yes, right? Because the equipment will be used to determine the quality of visions of the customers. So it will generate future economic benefit, right? It will gain income when the customer pay for the service provider. So it is probable that future economic benefit will flow to the business from the use of the equipment. Can the item be measured reliably? All right, how do you measure? So if you want to record this transaction is your asset, is your PPE. How are you going to measure? Because in this case, you are given the value, the equipment was paid in cash for 52,000. So that value 52,000 is the measurement used on the cost of the asset. Yeah. All right. So PPE are initially measured at cost that comprise of the purchase price, right? So how you measure the cost of the PPE is the purchase price, including import duties and non-refundable purchase tax after deducting trade discounts and rebates. So all these are the measurement. Any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner as intended by the management. So for example, if you have a machine, all right, and in order for you to have the machine to work, all right, in order for you to make use of the machine, you need to install the machine, or you need to put install a kind of generator, for example, yeah, or you need to link that to another machine. So all these costs, all right, additional costs incurred for the installation so that you can put the machine into use will be part of the cost of the machine, right? And the initial estimate of cost for dismantle and removing the items and restore the site on which it is located. So it also includes the cost of dismantling, right? If you have to dismantle the machine and put it back, for example, or you have to remove it, so all these cost transportation will be taken into account to determine the final value of the asset, right? So example here, we have Focus I purchased imported vision testers. The related costs incurred in relation to the testers were as follow. You have invoice price of 50,000. And then you are given a trade discount of 10%, but you have to pay import duties 3,500, transportation cost 1,005, installation cost 1,005, and admin cost of 6,000. So remember that the initial price is only 50,000, all right? But you also have to incur additional costs. So the cost of that tester, all right, the invoice price is 50,000, but you minus the discount. Right, 50 minus 10% or 50 times 90% is 45,000. So that is the net price after the trade discount. Is that clear? Right. So it means that 50,000 given 10% discount, so the net price is 45,000. But you have to add on the import duties, you have to add on the transportation costs, installation costs. In this case, the cost becomes 51,500. So the admin cost cannot be allocated to the machine, because admin cost normally you pay admin cost for a several function, right? You pay admin cost to manage not a particular asset, right? If the admin cost is for that particular asset only, then you have to take that into account. But in this case, the admin cost is more of a general cost, right? So general cost will be allocated later under profit and loss account. Right, additional costs that are related to service and maintenance are treated as expenses in the statement of profit or loss. So that's why the admin cost, just now I mentioned, will be treated as an expense in your profit and loss rather than will be attached to the cost of the asset. Costs which relate to additions and improvement that meet the asset recognition criteria are capitalized as asset. So there are two types of expenses here. We call it as a capital expenditure and revenue expenditure. So anything that is addition or improvement to the asset, all right, we call it as a capitalized expenditure. For example, expenditure that will increase the useful life, expenditure incurred to increase the quantity produced, increase the quality, not only the quantity, but also the quality, and also decrease operational costs. So all these expenses that you incurred is what we call capitalized or capital expenditure. So if it's a capital expenditure, the cost will be added together to the original cost, right? So it will be part of the total cost of the asset, right? So accountant regard to capital and revenue expenditure, accountants divide spending on plant asset after the acquisition into two categories, which is the capital expenditure that will increase the asset's capacity or efficiency or extend the useful life, or the, for example, extraordinary repairs, which are repairs that extend the asset or useful life. But the other one is what we call revenue expenditure. Yeah, expenses incurred in order to maintain the asset in working order. This is normally, we call it as a maintenance expenditure, right? For example, if you have a motor vehicle, right, you have to send the motor vehicle for repair and maintenance every 10,000 kilometer, for example, yeah? So, or maybe periodically in a year, you have to send 3 or 4 times, right, for maintenance of the machine. So you have to send that for repairs and maintenance. So this repair and maintenance is what we call revenue expenditure, right? It does not increase the value of the asset, but it maintains the effectiveness or the efficiency of the asset, right? So delivery truck expenditure, for example, you have two types of expenditure for your delivery truck. For example, your capital expenditure, all right, all capital expenditure will be debited to the asset account. So, for example, major engine or transmission overhaul, modification for new use, addition to storage capacity, and anything that increase the life of the asset. So, all these expenditure incurred for this purpose, for example, for the delivery truck, is a capital expenditure. But if you incur expenditure for the repair, all right, of transmission or engine, oil change, lubrication, and all this, right, is related to the delivery truck, but this is regarded as a maintenance or a revenue expenditure. So this expenditure will be treated in your profit and loss account as an expense, all right, debit and expense account. But if a capital expenditure, you debit to the asset account, yeah, because it adds values to the asset. Okay, subsequent costs, all right? Focus, I had a car, was acquired 4 years ago. Even though the car is in working condition, several repair costs have been incurred to maintain its working condition. The carrying value of the car is 800,000. Wow, very expensive car. During the current year, the following expenditure are incurred. So from all this expenditure, insurance and road tax, repainting costs, rust-proof treatment that will extend the lifespan of the car for several years, and replacement of timing belt, right? So from these 4 costs, you have to decide which one is the revenue expenditure and which one is the capital expenditure, right? So I believe that, right, the insurance and road tax, which is you have to pay that annually. Repainting cost is also an expense, and the replacement of timing belt is also an expense. All right, but the rust-proof treatment, all right, the 5,000 ringgit is a capital expenditure. Why? Because that expenses will have to extend the lifespan of the car, of the asset. Yeah, that's why it becomes a capital expenditure. So if it's a capital expenditure, then 5,000 ringgit will be added to the carrying value of the car, 800. So now the value of the car should be, right, 8,000, 800 and 5,000, right? So the insurance, the painting and replacement are expenses, so that one will appear in your SOPL, whereby your rust-proof treatment is capitalized, will be added together with the value of the motor vehicle just now. Yeah. Okay. Next topic, when we talk about asset, all right, we always have the issue of depreciation, right? So you know that, okay, just now you have acquired the asset, so you have to decide what is the value or how to measure the value of the asset. And now using the asset throughout the period, then you know that you have to allocate costs of the asset, right? So depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Yeah. So depreciation matches the expense against the revenue generated from using an asset. So there's a matching principle here. Revenue incurred, revenue earned, expenses incurred. Yeah. All assets except land wear out as they are used. So it means that you have all the asset that you have to provide depreciation. However, you have one asset which is called land, which will not be depreciated because land over time, rather than it depreciates, it appreciates in values. Yeah, land is always appreciate. So when it appreciates, you do not provide depreciation. Other assets which depreciate in value, it means that the value of the cost reduces over time. All right, you may purchase a machine that costs you 100,000, but over time of usage of the machine, the value of the machine depreciates. Right, it means that the value of the machine reduces. If you bought at 100,000, but after 5 years, the value now is only 20,000. Why? Over the time, there's a depreciation of asset. All right, the value of the asset reduces because of the wear out, because you use the asset, so you have to allocate cost of the usage. All right, some asset may become obsolete before they wear out. An asset is obsolete when a newer asset can perform the job more efficiently. So how you compute your depreciation? It has to be every asset, every item must be depreciated separately. All right, component approach may be applied. All right, so the chosen method is applied consistently, and yearly or ownership basis may be applied. So it depends on the type of the asset. So means that when I say that PPE needs to be depreciated separately, so it means that if you have a building, all right, building one will be the depreciation of building one will be computed separately from depreciation of building number 2. Motor vehicle 1 and motor vehicle 2 will be computed separately. All right. But if you have a lot of assets, all right, under the same values, right, individual asset, but it could be grouped as one, so you may apply component approach, whereby this whole group of asset, same group, all right, will be given the same depreciation rather than each item. They will give it as a component, all right. So once you choose the method of depreciation, you have to apply the method consistently, right? You cannot change. This year you want to use one method, the other year you want to use the other method. No, you cannot do that, right? Accounting is about consistent. And then there are two, whether you want to depreciate yearly or you want to use ownership basis, yeah? All right, causes of depreciation. Why you have to give depreciation? Because the physical and appearance of the asset due because of the wear and tear after several years of usage, the physical appearance will depreciate. All right, it will, the value, all right, you can see that the appearance depreciate, yeah. It becomes obsolete. For example, there's a changes in style, design, or technology. Time pass by, for example, the asset becomes outdated, or you can call it a depletion. Deplete, yeah, means that the amount, right, the amount or the volume reduces. All right, the natural resources, for example, you have mineral from earth, right? For example, we have oil in the under the sea, right? So, or mineral from earth, all right, as long as when you keep on extracting the natural resources, all right, there's a limited number of resources there. So of course the amount of the resources deplete. So that's why you have to provide cost depreciation for that, right? So in terms of the methods, just now we say that the method must be consistent. So these are the three methods which are commonly used. One is the straight line method. All right, how to compute straight line method is that the cost of the asset minus their residual value is divided by the useful life of the asset, right? Residual value is the value of the asset. For example, if I say that the useful life of the asset is 5 years, so after 5 years, you have to look at what is the residual value. So after 5 years, do you still can sell the asset at a certain value, right? So that is just based on estimate. All right. For example, I say that if my car useful life is 5 years, but at the end of 5 years, I can still sell my asset for 2,000 ringgit. Yeah. So that 2,000 ringgit is what we call residual value. Again, the residual value is an estimate. How you come up with that is normally there is an estimation method for you to use that, right? But that is not what we want to cover. But what you must know is what is a residual value, right? So depreciation under straight line method, what is the cost? You minus residual value, but there are also assets where have a zero residual value. It means that at the end of the 5 years useful life, then the value is zero, right? You cannot sell the asset at all, right? For example, you talk about motor vehicle. Normally motor vehicle, we give 5 years value, 5 years life, useful life, yeah? But after 5 years, you think that you can still use the motor vehicle? Most of the time, yes. Right? Most of the time, yes, but it's just that how much you can sell the motor vehicle at the end of the 5 years, then that will be the residual value of that motor vehicle. Yeah. All right, then you have the diminishing or reducing balance method where the rate is given and then whatever the rate of the depreciation you times by the carrying value of asset. So later we look at what do you mean by the carrying value of an asset. And also you have unit of production method, and this one is more for a machine, for example, in the factory, right, whereby you use the production method, the unit of production. How many units the machine can produce, right? And of course it depends on the efficiency of the machine, right? As the machine use longer, and then means that the efficiency will be lower. So how to compute is based on the production unit for the period. So for example, you can produce 1,000 units this month, right? But the estimated total production unit over the period is 100,000. And then you times by the cost of asset. So you will get the depreciation of the asset for the year based on the unit of production method. Right. So other things that you have to consider when you do the depreciation is that you have to capitalize the cost, right? And then the useful life, which is how long the company expect will use the asset. And then what is the estimated residual value, which is the expected value of a depreciable asset at the end of its useful life. And then you also have to looking at the cost minus estimated residual value is called depreciable cost. Yeah. Cost minus estimated residual value is the depreciable cost. For example, here we have data for truck. Cost of truck is 41,000. Estimated residual value is 1,000. So you have the depreciable cost of 40,000. Useful life is 5 years, and units useful in the form of units, it can go up to 100,000 months. So the depreciation rate is 40%. So how do you get 40%? Actually, 5 years period, all right, 40 over 5, that is 8,000 per year. All right, so 8,000 per year is the depreciation under straight line method. Right? If you use the rate given as a 40% depreciation rate. All right? So using straight line method, the cost is 41 minus 1,000 over 5 years. So that is 8,000 per year. Right? That will be under straight line depreciation. So when you have this is how you record. right? Your depreciation is an expense. That's why you debit your depreciation expense for truck 8,000. And the other account that will have to be recorded is what we call accumulated depreciation. I mentioned last time that accumulated depreciation is a contra asset. So normally asset has a debit balance, but a contra asset has a credit balance. So accumulated depreciation is the truck, for the truck is 8,000. So you credit that account 8,000, right? So remember, whenever you have depreciation, debit your depreciation expense, credit your accumulated depreciation. So if you were doing this on an annual basis, all right, annually you have to record this expenditure. Right? Don't forget depreciation and accumulated depreciation. Right? So this is the entry to record. All right. When you have profit statement of what do you call that? A financial position, for the truck, you must always record the truck at the cost, right? Why do you get the cost? It's 41,000 is the cost of the truck. You do not take that estimated value here, right? You only always take the cost of the truck, 41,000, and then you minus your accumulated depreciation, 8,000, right? So why is it called accumulated depreciation? Because this account will accumulate the depreciation which is given on the truck. So year 1, 8,000. When it comes to year 2, the accumulated depreciation will be 16,000. Next year, plus by another 8,000. Every year, the depreciation account, all right, every year you have a depreciation expense, all right, as your expense in your profit and loss. But the accumulated depreciation will be in your profit and loss account. Right? Right. The book value of the asset, which is the net, all right, cost minus accumulated depreciation is what we call net book value, is reflected on the balance sheet. So you must always show your asset minus your accumulated depreciation in your balance sheet. Right? So straight line depreciation schedule, if you look at here, all right, straight line means that every year is the same value, straight line, right? Because whatever the cost or minus residual value divided by 5, so 8,000 will be given every year for 5 years, right? The accumulated depreciation, it will increase annually, right? 8,000 first year, second year plus another 8,000 now becomes 16,000. Third year plus another 8,000, now it accumulate to 24,000. Fourth year plus another 8,000, now accumulated is 32,000. And final year, you have accumulated of 40,000. But remember that the cost of the asset is 41,000 just now, right? So when you minus your accumulated depreciation, then you see that the book value decreases over time. But at the end of the 5th year, you have 1,000 here that shows the residual value of the asset after 5 years period. Yeah. All right. In terms of the unit of production method, all right, depreciation per unit, you have to compute the cost of the asset, which is 41,000 minus residual value over useful life in units. So in this case, it was given that the useful life in units is 100,000 miles. So in this case, the depreciation per unit is 0.4 or 40 cents per mile, right? And step number 2, units of production's depreciation will be depreciation per unit, which is the 40 cents times by the current year usage. It depends. So this one, how much is the usage during the year? So it depends on the performance, right, of the machine, for example. So for example, in this case, the truck travels 20,000 miles. You times by the 40 cents per mile. So the rate is 8,000 per year. Right? The rate under the unit of production method is similar, 8,000, but the method of computation is different. Right? The value of depreciation is 8,000, similar to your straight line basis, but the method of computation is different. Smart touch learning expect to drive 20 miles in the first year, 30 miles in the second year, 25,000 in the third year, 15,000 in the fourth, and 10,000 in the fifth, for a total of 100 miles. So once you get your depreciation per unit, you can now compute your depreciation for year 1, year 2, year 3, year 4, and year 5 based on the information provided. All right, for example here, the number of units given. So you know that, all right, the depreciation expense is not the same for every year because it depends on the number of units used during the year. Yeah, so it's not the same, but the residual value will always be the same because the formula is always your cost minus your residual value divided by the number of units, right, that is estimated to be used over the 5 years period. As you can see, the accumulated depreciation is not straight line, yeah. So it increases depending on the depreciation given for the year, but it's an accumulated depreciation. The book value, how you compute your book value, whatever cost, in this case, your book value is always your cost, and then you minus your accumulated depreciation, then you get your book value. Right, and then the following year, book value minus accumulated depreciation, you get another lower book value. Yeah, so from 1 year to another, the book value will decrease. Okay, this one, Focus Eye purchased an auto refractor to be used during an eye examination for 36,000. So that's the cost. Yeah. It is estimated that the equipment will be used for 10 years and it could be sold at the end of useful life for 4,000. All right, reporting period was 31st of December. So now you have what information? You have the cost is 36,000. You can use it for 10 years and the residual value is 4,000. So what would be how to compute your depreciation using the straight line method? The depreciation would be 36,000 minus 4,000 divide by 10 years. So that's how you get 3,200 per year, right? Per annum. Using the, if the equipment was acquired on 1st July, right? Remember that your year end is 31st December and you acquired on 1st of July and using ownership asset. So it means that you are going to compute the depreciation based on how long is your ownership period. So in this case, if you purchase 1st of July, your year end is 31st of December. How many months is that? It's 6 months only. Right? 1 whole year, you have 12 months. But under ownership asset, you're going to apply 6 over 12 because why? You only own the asset for 6 months period. So instead of having a depreciation of 3,200, your depreciation would be 1,600, which is half only. Because why? The ownership of the asset during the year is only for 6 months rather than 1 year. All right, in terms of methods, all right, we have the straight line methods, the unit of production method, and double declining method. So looking at the asset characteristic, all right, straight line method generates revenue evenly because why? The expenses is even. All right, you know that the expenses is straight line, so it's even. All right, equal amount each period. The depreciation, an example of asset is normally is a building, right? But looking at the unit of production, the depreciate due to the wear and tear rather than obsolete, right? As this is more usage, more applicable for vehicles and machine, right? Unit of production. Effect of on depreciation, more usage costs larger depreciation because it depends on the usage. The more units, the more mileage that you go, for example, the more is your depreciation. Okay. A double declining balance produce more revenue in early years because double declining, it means that the depreciation gets more, it started with one number and then the second year it doubles, the third year it doubles of the second year, all right, the fourth year doubles of the third year. So it means that the depreciation from small, it gets bigger over the years, all right, rather than straight line. So the depreciation is actually on increasing. Yeah, means that you can have let's assume 1,000 in the first year. Second year, it becomes 2,000. Third year becomes 4,000 because what? 1 times 2, right? 1 square, 2 square, 4 square, like that, right? So the produces more revenue in early years because why? The expenses is small. The depreciation expense small in the early years. But as you go along, the depreciation gets higher, right? Higher depreciation in early years, less later. Terbalik ke? Oh, double declining balance. That one is reducing balance. All right, double declining balance, it means that more revenue in early years because, but this one is wrong. Produces more revenue in early years. So it means that the depreciation is small. Higher depreciation in early years. Kalau higher depreciation means that lower revenue. Right? Okay, later we check on this. Please check on this, yeah, double declining balance. Sometimes question, when you have this kind of question, normally is a multiple choice question. We'll normally test you on this understanding. All right. Okay. Measurement after recognition. After the initial recognition, PPE are measured using cost model or revaluation model as its accounting policy, and the policy should be applied to entire class of PPE, right? We have the cost model where we look into the cost using the cost less accumulated depreciation. So that's what's called a cost model. So what we are looking at now is that we already have the asset, we already have the measurement. But later, we want to look into the value after some time. All right, so what is the book value? So the cost model, we look into the book value. All right, so the cost minus accumulated depreciation and any accumulated impairment loss. The fair value of property, plant and equipment is not taken into consideration. Fair value is what we say that is the market value lah, of the asset. Revaluation model is PPE are carried at a revalued amount. If the fair value can be measured reliably, all right, less any subsequent accumulated depreciation and subsequent accumulated impairment loss. So in revaluation, it means that you want, rather than looking at the historical cost, where the cost minus the accumulated depreciation, at one time you want to revalue the asset, all right? So the revaluation is important if you think that the market value or the fair value of the asset is not, is very different from the book value. So you need to do a revaluation. So using a revaluation model, you must be able to identify what is the revalue amount. Yeah. All right. Example here, Focus I acquired a piece of freehold land on January 2000 X4 for 1 million. And then when December 20 X4 is the same year, the fair value of the land was 1.5 million. Show the carrying amount of the land as at 31st December if the company adopts cost model or if the company adopts revaluation model. So if the cost model, land, yeah, because there is no depreciation for land, so we do not apply any depreciation for the land. So if you use the cost model, then the value, the carrying value of the land is 1 million, which is the cost itself. But if you use the revaluation model, the value at the end of 20x4 is the fair value of the land, which in this case is the 1.5 million. All right. So how you decide depends on your accounting policy. If the accounting policy say that, okay, we want to use the fair value, but remember the policy must be consistent over the years, yeah, for the company. So if the company wants to use the revaluation model, then there are some adjustment that has to be taken into account. All right. Surplus on revaluation. So for example here, the cost is 1,000 and now the fair value is 1.5. So under revaluation model, the value now, there's a surplus in the revaluation. Why? Because the carrying amount of PPE, which is the 1 million, is less than its fair value. You know that the carrying value is 1 million the fair value is 1.5 million. So there's a difference of 500,000 there. All right, the 0.5 million difference is a surplus because the fair value is higher than the carrying value. So when you have that, PPE is less than its fair value, then you have to do a surplus or revaluation. All right, recognized in revaluation reserve or SOPL, and then disclose in the statement of profit and loss and other comprehensive income. So you have to show the differences in your SOPL. All right, but if you have the deficit on revaluation arises when the carrying amount of PPE is more than its fair value. For example, if the carrying value is 1 million, that fair value is 800,000, which is lower. So there's a deficit in the fair value. So because of that, you do have to do deficit on revaluation. All right, recognize in SOPL or revaluation reserve on revaluation of the same PPE. So how you are going to do that, right? Let's say example again, carrying amount is 500,000, fair value if it's 600,000. So if the fair value is 600,000, is this a surplus or deficit? Revaluation.
Surplus.
Surplus. Yeah. Thank you. I thought that everyone gone to sleep already. I was talking to my staff. Thank you for still being here. All right, so you had the 500,000, now you have a surplus revaluation. All right, so when there's a surplus revaluation, it means that the value of the land now increased to 600,000. So the difference is 100,000, right? So the increase, you have to debit your land. Freehold land, the land, you debit your land 100,000. Now, land initially it was 500,000, now you debit for another 100,000. So now value of the land is 600,000. But you also had to put that into revaluation reserve of 100,000. Revaluation reserve is a profit and loss. So if it's a credit, it means that it's something that increase the value of the owner's equity, right? Revaluation reserve means that it's a credit side in your SOPL, so it means that it increase your owner's equity. But if the other way around, where we have your fair value is 450,000, it means that there's a deficit of revaluation. So when there's a deficit of revaluation, it means that the land, initially it was 500,000, now you have to revalue to 450,000. So you have to credit your land 50,000 and debit your SOPL 50,000. Yeah. In this case, they put SOPL, but both appears under your SOPL. All right. Both surplus and deficit that appears in your SOPL. One is revaluation reserve. The other one, because reserve is something that increase the owner's equity. All right. Here you just put SOPL. I think that you can have revaluation reserve on the debit side as well. Yeah. If you only have one account. All right. Are you okay? So far?
Yes.
I'm sorry that it has to be theoretical first. I have to explain first, then only later we do the tutorial. Right? I hope that you have to bear with me in explaining this, because we know that some of us do not have any background, so at least they have to follow all this. Yeah. So I hope that you don't go to sleep, and please, continue a bit more. Yeah. You have about 20 more minutes to go. All right. And so remember that just now we have the acquisition of asset, and then we have the usage of asset. During the usage of asset, you have to provide the depreciation. All right. And then you have to look whether you have to do revaluation of the asset. And now we have to come to the third cycle, which is when you want to dispose or you want to sell the asset. All right. The disposal or sale of assets. So there are few steps that you have to look into account. All right. So remember that initially you purchase the asset, you have the asset account. All right. And then during the year you provide depreciation, and then you also have your accumulated depreciation account during the year. When you sell the asset, all right, you have to means that you are going to dispose the asset means that you have to take out the asset from the account. You have to cancel your depreciation expense. You have to you have to cancel your accumulated depreciation account. Yeah, and then when you sell, normally you do receive some cash, and that cash you will see whether you are making gain or loss on the disposal. All right. So there are steps for you to do when you want to record your disposal of your asset. Number one is that you de-recognize the old, the dispose of or sold asset, and adjust or remove the asset and accumulated depreciation related to the asset from the book of account. All right. So you want to debit your disposal account, credit your asset account. Yeah. So we are going to open one account. All right. Disposal of account. We open one T account disposal. So the asset, remember the asset is a debit account, but because now we want to dispose the asset, now we are going to credit the asset account, right? Credit your asset. And number two, adjust your accumulated depreciation. Remember, accumulated depreciation is a contra account, it's a contra asset. It means that it's a credit balance. So when you want to dispose your asset, you're going to debit. Remember, you want to cut off, you want to settle, you want to close the accounts. So when you want to close the account, you're going to debit the accumulated depreciation account, right? Debit your accumulated depreciation account and credit your disposal account. What else you have? Number three, record the value of any cash received from the disposal or sale of the asset. So when you receive cash, of course, cash is debit. All right. So, and then, all right, you credit your of the amount you receive on the disposal of the asset. All right. And finally, based on the transaction just now, you're going to see whether there is a gain or loss on the disposal. All right. So you do not know whether there's a gain or loss on the disposal until you have all the items number 1, 2, 3 put into the accounts. All right. So if you look, okay. Let me. Okay, I stop presenting now. Okay. Let me show you. If I show you in my whiteboard, I know that my whiteboard is very small. I want to stop presenting. Can you see my board now? Okay. All right. Okay. I just want to show you, yeah. How many assets involved?
It's 3 o'clock.
Number one is your assets. All right. Let's put that as a idea more. Okay. It's not mirror picture, yeah. Okay. Let's put it as a motor vehicle, right? So we have the motor vehicle asset, and then we have the accumulated depreciation. Okay. And then we have your receive your cash. And then you have your disposal account. Can you see this clearly?
Yes.
Okay. So remember that your motor vehicle is always a debit, yeah, because it's an asset. So normally you will debit your accounts. Accumulated depreciation is a credit in nature, right? Because it's a contra asset. So normally it's a credit. Cash is always a debit, all right? But when you are talking about disposal of your motor vehicle, right? So what you do is that you are going to credit your account. Okay? Motor vehicle upon disposal, you credit accumulated depreciation, you debit. Cash, you receive. You still receive your cash, right? Because when you dispose, you receive cash, so you debit your account. But the disposal account is actually the contra of this. All right, so you dispose of motor vehicle, you credit means that you're going to debit your motor vehicle here. Accumulated depreciation, you debit here means that you're going to credit your accumulated depreciation. And cash, you receive cash, you debit here, so cash is here, right? So this is then you see whether you have a gain or loss. So let's example here. Let's say that motor vehicle, the cost is, let's say, is 100, right? So when I dispose, I have to dispose 100. So I will debit my disposal account 100. Okay. Accumulated depreciation over the years, it was 40. So I credit 40, accumulation for 40. Can you tell me what is the book value of the motor vehicle based on the information provided here? What will be the book value?
60.
Again, what is book value of the motor vehicle? How you compute book value?
The cost of motor vehicle minus economy.
Very good. The cost of the motor vehicle minus your accumulated depreciation. So 60 is actually what we call book value. Right? So let's say that you can sell the motor vehicle for how much? 60,000. Right? So 60,000 you debit here means that you're going to credit your disposal account credit 60. If I say that, oh lama, I tak nak buat 60. Cannot. No gain, no loss nanti. Alright? Let's make it 20. Alright, I can sell the motor vehicle for 20,000 only. The book value is 60,000. Do you think that I'm making a gain or loss?
Loss.
It's a loss, yeah, because the book value is 60, but I can only sell the motor vehicle for 20,000. So I'm making a loss of 40,000, right? So how do you know that I make a loss of 40,000? So look at this disposal account here, right? If I were to total, all right, on both sides, I have right? I have 100 here and 40 and 20. 100 is the cost of the motor vehicle. 40 is the accumulated depreciation. 20 is the cash I receive for the disposal of the asset. So if you look at here, what is the big amount? Is the 100 is the total here. All right, so get the 100 here. So if I have 100 here, it means that what is the missing value? Missing value is 40, 20. It has to be 40. Okay. Did I say just now 40, is it a gain or loss? I can sell for 20 cash. It means that I'm making a 40 loss. Right? So this 40 means that it's a loss on your disposal. Yeah? So you see that loss here is a credit. So if I were to open account loss on disposal, or I put here, all right, so this debit is 40. This is an expense because why is a debit? All right, debit is an expense, loss is an expense. But you get that? Is that clear?
Yes.
Okay. Where is my loss tadi? Okay, loss, yeah, 40. But if I say that I managed to get amount of 80,000, I can sell. The book value is 60, but I can sell for 80,000. Right? So here, if I were to correct this, how would it appear? I have cash, I receive 80,000 cash. It means that the big amount is 120, here is 120. So the difference is 20 on this side, right? So this 20 is a gain. How do I know it's a gain? If this is debit, it means that my account here must be on the credit side. So credit here is a revenue. Revenue means that you are making a gain on your disposal. All right. So now what you have to know is that whenever there's a disposal, you must have number one, you want to credit the asset account. Number two, you debit your accumulated account. Number three, you are going to debit your cash account because you receive cash on the disposal of the asset. All right. You open up the disposal account and I put in the contra of the transaction that you have. Right. Remember that you credit, so means that in the disposal account you debit your motor vehicle. Right. So all this you can write all this as your as means that it goes into your disposal account. Right. 100 goes into your alamak tak tutup tadi. 100 goes into your disposal account. The 40 accumulated depreciation goes into your disposal account. This one goes into disposal accounts. This one goes into disposal accounts. All right. So when you have credit here, disposal will be debit. Debit here means that disposal credit. Debit here, disposal is credit. So you have the debit, credit, debit, credit, debit, credit. Right? Then you decide whether is it a gain or is it a loss, depending. All right? Depending on how much is your collection from the disposal of the asset. Right? Does that help you to understand the process better?
Yes.
Very good.
Yes,
Thank you.
madam.
All right,
Yes.
good. I'm looking for the cover for this marker. Dah kering dah. Okay. All right. What is the time now? 3:08. So, so how do you find topic under asset? So means that we have covered your PPE. All right. I will give you the tutorial question. All right. Please do that tutorial question, and remember that this topic will also be included in your midterm next week. And we have another topic which is the intangible asset, which is very minimal. All right. I can do that very quickly. And then we can do your tutorial on your PPE and intangible asset. Is that okay?
Yes, madam.
Yes.
So
madam.
I will share with you the tutorial question after this. All right, and then you can start try to do the tutorial questions. And if you have any question, you can always ask me in the WhatsApp group. And hopefully, inshallah, next class, we can start doing your tutorial question. Before do the tutorial question, I want to do the intangible asset. I will cover that topic first. Then we can do together the intangible and tangible. Yeah. It's almost similar intangible asset. It's just that intangible asset is asset that is intangible. You cannot touch the asset. All right. Example is your goodwill, your copyright, your patent. So all these are your intangible asset. All right. It's just that there is a value to that. Right. You have to record the value. But again, similarly, you have the allocation of cost throughout the year is the same like your PPE. It's just that the name is amortization. If tangible asset, we call it a depreciation. Intangible asset, we call it as amortization. That's all. Right? And of course, you can read a topic on intangible asset a bit, all right? But the concept is the same. Yeah. Recognize where is the value, the cost, and whether how you decide whether is it an asset or not is the same. It's just that you cannot touch. That's why it's called intangible asset. Yeah, and then depreciation, rather than call depreciation, we call it as amortization. Amortization also we have several methods, but most likely it's a straight line basis. Yeah. So, well, I think I covered your intangible asset. Okay. Any question? I've been talking the whole class. I'm sorry, I have to do that. All right, next class we do the tutorial, okay?
Madam,
Yes.
madam, can you give us some exercise like what kind of question will be in our test exam? I mean, our mid exam.
All right. You, we had the quiz just last week, right? So it's just that the quiz last week, we have to prepare the financial statement. Remember, you have the journal entries, and then you have to prepare the trial balance, and then the financial statements. But in the midterm exam, I think that because we do have the same, I think that you have to do the adjustment, right? Remember the prepaid and the accruals topic in the last class, right? So maybe we can do a few more example or tutorial on that before your midterm. So let us finish on Thursday. We finish this PPE, right? And then hopefully we can have some revision before you do your midterm next week. Is that okay?
Yes, madam.
Yes,
And
madam. Okay.
your midterm is you have two parts. One is the multiple choice question, and the other one is the, what do you call that? Where you have to prepare the financial statements, the journal entries, all that. Okay, right? So I think that's all for today. All right, don't forget to fill up your attendance, all right, and give feedback on what we have today. If you still think that you are